All right, on to our markets now. Following yet another poor showing on U.S. markets, Asian stocks tumbled by a greater degree in today's session. This as market anxieties continue to bedevil market activity. The Nikkei share average declined by 1.4%. The Hang Seng Index lost 1.34%, while the Shanghai Composite Index ended down 0.8%. U.S. markets remained lethargic at the beginning of the week, ending on a subdued note, with tech counters leading the downward trend. The Dow Jones Industrial Average ended up 0.08%. The S&P 500 declined by 0.5%, while the Nasdaq fell by 1.21%. And so we take a look at local indicators. So currently we see that the all-share index is trading in positive territory. It's up 0.4% at 87,000 points over that. The currency is trading at 18.43 against the US dollar, 19.29 vis-a-vis the euro, and 23.25 against the British pound. In terms of our commodities, we see that gold is trading at $2,938 an ounce, platinum at $960 an ounce, while Brent crude oil is trading at $74.32 a barrel. Well, for more on the markets, let's now speak to Martin Smith. He's a portfolio manager at Anchor Capital. Thank you so much, Martin, for joining us. So US markets have continued on their downward trend, and I suppose there's not much to really be cheerful about, especially given Trump's trade tariff policies. And I also understand that he's indicated that the Mexico and Canadian tariffs that have been paused are set to go ahead, I presume, at the beginning of March. And in the meantime, there's reference being made to the possibility of stagflation. What does this all mean for global markets?
I think it means more uncertainty. I mean, you've got Donald Trump and tariffs, you've got what's happening with interest rates and inflation, geopolitics also still playing a bit of a part. And then if you kind of put that on this side, on the other side of the kind of coin, you've got valuations being very high still in the US on aggregate. So it's leaves us in a bit of a tricky situation. We've got uncertainty and high valuations. So it doesn't bode particularly well for the short term. But as we know, this market's been very much in kind of seesaw territory the last couple of weeks and maybe month or two, where it's just everything seems okay at one stage, and then all of a sudden, like we've seen the last day or two, everyone's uncertain and valuations are high. And so I think it's just a continuation of that. But I think that volatility will continue for the kind of foreseeable kind of 6 to 12 months. So yeah, that's where we're at.
That's where we're at. So in terms of important economic news here at home, we're going to be getting the first CPI print of the year, that is for January. I see some economists are expecting a couple of not like a 0.1 percentage point increase, but maybe a couple of percentage point increases, which is a bit unusual. So maybe about 3.3% for January, which is, of course, still very much in line with the Reserve Bank's target. But then how does this feed into your outlook for monetary policy and how that could also affect the market?
Yeah, so you're 100% right. The kind of broad consensus out there is around 3.2, 3.3. So ticking up slightly, but as you mentioned, still within the band of 3 to 6%. The way that's kind of shaping monetary policy is, look, we were looking for 2 to 3 cuts at the beginning of the year. So 0.5 to 0.75 percentage points of cuts for the year. But I think that's probably now 1 to 2, which obviously already had the one now. But you've got inflation ticking up ever so slightly, but you've also got the potential of that increases putting inflationary pressure on South Africa. So that'll maybe also dampen the hopes of a second rate cut now in March. And then you've obviously got what's happening in the States also informing us a little bit insofar as how we should be doing things, because you don't want to move too quickly ahead of the States, because then that can cause the currency and other things to go in the direction that you don't want them to, which is then also inflationary. So I think all of it leads to the point where we are at the moment, which is kind of maybe a 50% chance of a cut now in March, and then that'll be it for the year, unfortunately.
Yeah, very quickly, Martin. You know, I've been looking at the Prosus and Naspers shares. They've been surging ahead quite nicely. I mean, with Naspers moving close to about 4,600 Rand per share. What's going on with those particular counters, and what are your thoughts about them? And would you invest or stay invested in them?
Sure. So, I mean, I think it's been a very volatile start of the year for Naspers, Prosus, and Tencent. Obviously, all kind of linked. At the beginning of the year, you had Tencent fall on the military watch list of the states, and you saw the share sell off about 15-20%. It bounced back really nicely from there and kind of made all-time highs. But then yesterday you saw Tencent getting caught up a little bit in this sell-off that we saw in the States, and people maybe being a bit worried around AI and tech. But at the same time, you also saw Prosus buying a business called Just Eat for a 63% premium, which the market didn't really like. So those two things saw the share price come off quite a bit. But I still think in the long term, medium to long term, I still think these are great businesses to own. I just think volatility, given the kind of Chinese exposure that it has and US-Chinese relations at the moment, I think you can see a little bit of volatility. But medium to long term, absolutely ones to buy/hold, in my opinion.
Excellent. Thank you so much for your analysis. As always, Martin Smith, he's a portfolio manager at Anchor Capital.